conflict in the Middle East, its impact on the oil market and expectations of a shallower Fed easing cycle present some speed humps for South Africa's economic recovery. On the oil front, however, an oil slick can be avoided. Financial Mail reporter Claire Bissseker joins us with more detail on the oil market. Thank you so much for your time, Claire. Of course, we know the adverse effects of inflation on South Africa's consumer demand and the economy, and really the oil market is a big component of that inflation picture. How much of a threat do geopolitics present to the oil market at the moment?
Well, the situation in the Middle East is extremely worrying. What started out as a conflict between Israel and Hamas a year ago is now on the cusp of a regional war in a region that supplies about a third of the world's oil. So what happens to the oil price depends on the escalation in that conflict. But the consensus is that it would take a very severe deterioration in that conflict to put oil back into triple digits again. The worst case scenario at the moment is that that Israel attacks Iran's oil or nuclear infrastructure, and that Iran retaliates by impairing maritime traffic through the Strait of Hormuz, which is a vital choke point through which about all Middle Eastern oil travels. So the expectation is that the US or China would respond to send in the Navy, reopen the strait. But even the uncertainty of that could easily push oil over $100 a barrel, and that would obviously be very bad for global inflation and global demand. That's the situation. Yeah.
You talk about triple digits, that $100 per barrel level. Is that the level where we'd actually then need to start panicking? And maybe just before then, yeah, sure, the trajectory of inflation and, the oil price could change, but maybe that's where the panic sets in at that level.
Yes, I think so. I think that is where panic would set in. Mm-hmm. The reason we don't have panic yet, and it's been interesting watching in the last few days, oil did spike through $80 a barrel earlier this month, but it's since come back to $74 a barrel, which is only about $2 more than where it was at the end of September. It's at $72 a barrel, which is fascinating. But the reason seems to be is because there's this belief that OPEC would step in, that there's plenty of spare capacity in OPEC, and it wouldn't let the situation run to that extent. From South Africa's perspective, even oil at $80 or $90 a barrel isn't worrying. And you must remember that the SARB, that the Reserve Bank's own benign inflation forecast, is based on the assumption that oil will average about $83 a barrel this year, and $80 a barrel in each of the next 2 years. So that provides a level of comfort for South Africa.
It's quite interesting that there's this belief that OPEC would step in, that they wouldn't let, these, oil supply constraints materialize. Would they not, though, be compelled or maybe get a kind of an idea of boosting their revenues by limiting the supply and production of oil due to the attractiveness of an oil price hike?
Well, you must bear in mind that the context in which this is happening is quite an interesting one. At the moment, before the conflict, the oil traders were predicting a glut and, in fact, a price war in the oil market, which could push, they thought, by next year, the price of oil would be below $70 a barrel. And the reasons for that is that global demand is slowing, particularly out of China, that there's this accelerated shift towards electric cars. And interestingly, there have been reports that Saudi Arabia is close to actually abandoning OPEC and abandoning those production cuts, that it's keen to perhaps make a break for market share instead of sticking to these production cuts. So Saudi is emerging as the most likely candidate that could not only step in because it has ample spare capacity, but also would be willing to step in if the oil price looked like it was going to rise to levels which could further choke off global demand.
Yeah.
So that is the context in which this is happening.
Well, of course, we can't talk about inflation and oil without talking about the rand, and it has actually been quite strong recently. But just talk to me about the role of the rand here if the situation got worse with the oil market, if there are certain drivers that could maybe exacerbate the rand's, I guess, adverse effect on the inflation picture.
Yes, I mean, what we don't want is oil to go through $100 a barrel.
Yes.
That would obviously make inflation sticky, but it would also weaken global demand and cause a global risk off, in global risk appetite. It would diminish global risk appetite.
Yeah.
And that would have a knock-on effect on the rand. And those are both, the stickiness of inflation and the weakening of the rand are both red flags for the SARB. And we don't want anything to stop the SARB cutting or anything that could detract from our growth potential. As you mentioned, the rand has weakened a bit recently, and that is actually got not much to do with the oil price, but it's got everything to do with the behavior of the US Fed. And you would have seen recently that strong US labor data has changed expectations around Fed cutting. Instead of the markets now expecting the Fed to cut 50 basis points in November, the consensus is shifting to a 25 basis point cut. And that has allowed the dollar to strengthen a little bit, and it's caused the rand to come off after a strong run to about closer to 17.50. It was about 17 to the dollar earlier in September. It's not worrying, just like a $74 oil barrel price isn't a worrying situation for South Africa yet.
Yeah.
It doesn't threaten our inflation outlook. It doesn't threaten the interest rate cutting trajectory yet. The economists I spoke to for this cover story said you'd have to have the rand rising back to 18.50 to 19.50 to the dollar, and a sort of $100 oil, price for oil.
Yeah.
And you'd have to sustain these at those levels for it to affect our inflation or rate cutting trajectory.
All right. Well, let's hope that things do not get to that point where we are at $100 per barrel for oil, Claire, and actually quite encouraging to see that as much as we have seen some elevation in the oil price, that it has not been to worrying levels. Thank you so much for your time and for your insights. That was Financial Mail reporter Claire Bissseker.